good afternoon or morning, depending on where you're logging in from. My name is Cory Parnell. I'm a principal at BGM. And BGM, we've serviced the cannabis industry for since 2014. As my old partner, Jim Marty used to say, being in this industry is you measure it like dog years. So it sure feels like that at times. Currently, we provide services for over 600 license holders throughout the U.S., everything from large MSOs to single store operators. And as usual, what we try to do is bring in guest speakers to discuss various subjects that we hear from our clients. And I'm excited to have Tripp Murray on this call as well. I'm going to ask him to introduce himself. But we do like to make this an interactive presentation. So if you do have a question, please ask it in the question area, and either we will answer it at the time, or if we think it's going to be addressed later, then we'll make sure that we cover it later during the conversation. So again, excited, worked with Tripp for a very long time, but Tripp, if you could give yourself kind of an introduction and your background in the cannabis space, that'd be greatly appreciated.
Sure, that sounds great. And thank you for inviting me for this tour. Cory, so I joined the cannabis industry in 2014. I had originally started working for a group in New York City that wanted to make an investment into the cannabis space, and worked as a contractor for them, primarily concentrated in Colorado at that point in time, as that's where the industry was sort of the epicenter of adult use and regulated form. After that, I have worked for a company called Champlain Valley Dispensary. I live in Burlington, Vermont. It was the largest operator in the state, and then moved over to a company called Revolution Global, which is a multi-state operator, meaning that we had operations in multiple states, from dispensaries, cultivation, processing, and served as the CFO for them for about 6.5 years. Since then, since January of 2023, I restarted my own practice consulting in the cannabis space, serving as a fractional CFO and also as a chief restructuring officer for cannabis operators. So it's great to see everybody that has joined. And again, Cory, thank you for inviting me to talk today.
Yeah, one of the things when Tripp and we're kind of talking about doing this, one of the things that kind of came up in conversation was about the history of financing in the cannabis space. So I thought that was a great starting point. So if you wouldn't mind, from your perspective, kind of the financing history of cannabis.
Yeah, it's an interesting evolution/revolution that sort of occurred in the cannabis space. When it started in 2014, and I'll specifically talk about Colorado at that point in time, but Colorado, for instance, had a prohibited non-Colorado individuals to owning equity within Colorado operations. So that led to a significant amount of high net worth investors. Nobody was willing to participate in this from a capital standpoint from any of the banks at that point in time, and there was no equity markets for this. So it was primarily high net worth individuals from when I started 2014 to about 2016, 2017 timeframe, where we then started to see this new form of capital coming. I think probably the largest provider of capital of this sort in sale leaseback transactions is a company called IIPR, publicly traded, New York Stock Exchange. And what they would do is they would allow operators to deleverage their balance sheet from a fixed asset standpoint. they would purchase the cultivation facility and charge a lease back rate to those operators. And they did some retail as well, but primarily the biggest capital expenditure in the cannabis space is your cultivation. And that allowed operators to receive a cash payment for equity investments that they had made in the cultivation area. Then in sort of the late 2017, 2018 timeframe, you started to see the Canadian Stock Exchange, the CSE, open up and allowed US operators to list, and in theory, what people would call a public offering. More technical, it was a reverse merger, where a US operator would merge into a shell company on the CSE, raise what was technically a PIPE financing, private investment in public equity, and that would then get them listed. And companies raised hundreds of millions, not billions of dollars through the CSE. Then in sort of the late 2018, 2019 timeframes, you started to see a lot more private, non-bank companies come to the market. Companies such as AFC Gamma, publicly traded mortgage REIT company, Chicago Atlantic, Focus Growth, companies of this sort. And they were providing more traditional bank financing, where they would look at the real estate value that you had and offer, somewhere at that point in time, 17 to 22% interest rate. But it was a shorter term in duration than a sale leaseback. It had a finite end to it, which would allow you, if operations were successful, to be able to pay off the loan and still maintain control of your assets. Into the 2020, and now you're starting to see a lot more credit unions and local banks coming into the arena. They are enticed by the idea that there is availability to get increased spread on their margins, lending margins, versus what they get from a traditional, non-cannabis operation. And so it has allowed for the last pretty close to 2.5, if not almost 3 years, where you've seen the most amount of growth in capital formation for cannabis is in the non-traditional and traditional banks, debt financing. The equity market has been pretty closed out to the cannabis operators over that time frame. So we're experiencing a lot of cannabis companies that have taken on debt at higher rates than what most people would expect. But in the cannabis space, if it's somewhere in the 12 to 17%, you're sort of in the middle of where market rates are. But with that being said, a lot of this debt now that came in the 2021, 2022 timeframe has maturities. And this is where sort of the refinancing and restructuring side of what I offer comes into play.
Yeah. So what what are the key drivers behind financing decisions and making that final decision to look for either new financing or refinancing?
So it's it's got to be driven in an area of sort of I like to take cannabis out of it and just say, let's talk about when you would do financing for a normal company, and then you put the word cannabis on top of it. There shouldn't be any special treatment because you're a cannabis company on when you need to access capital. So accessing capital from both an equity and debt perspective, you need to be able to ensure that the return on the capital that you're going to be borrowing is greater than the cost of the capital, or else that doesn't make sense. And from a management's perspective, you need to look at what is that capital going to accelerate. Where most cannabis companies, I would say, are not in the position of doing some sort of dividend recap where they're going to go borrow a bunch of money and then distribute it out to their shareholders and pay it back. This is for increasing revenue and overall profitability for the company. If you've gotten to a place where you have cultivation, and let's just pick a random number, and just to say you have 10 rooms, but you're only 6 rooms completed, and you need another $5 million to finish the 4 rooms. Well, if the model that you put together under a bunch of scenario planning says that I can absorb that 15% cost of capital for borrowing that $5 million because I'm going to generate greater profit, then it's worth pursuing. If you're doing it because you have gotten yourself now into financial difficulty, it's going to be very challenging to find a bank that is willing to give you either a mortgage loan, a working capital loan, to be able to use that to stave off any other payments that you have. So, it comes down to making sure that the company itself is able to utilize that capital efficiently. And the banks will put you through, both the traditional banks and the non-traditional bank financiers will put you through, financial modeling tests and ensuring that they are comfortable in lending you the money, because their number one job back to their shareholders is that you return the capital and you pay your interest, or else you're going to end up in default. And none of the lenders want to be owners of anybody's license. That's not their job. That's not their business. They want to collect their interest payments and make sure that the principal comes back.
Yeah, and what we're talking about, Tripp, was really the number of institutions out there that are banking or providing loans. I mean, what would your guesstimate be as far as how many?
I would say that there's probably, there's a handful, and a handful meaning like less than 5 usually in each state, that are either a local lender or a credit union, a local bank. And the reason that I define credit union and a local bank versus the large money center banks such as a JP Morgan, Citibank, Wells Fargo, is that most of the boards of credit unions especially have gotten comfortable with the aspect that the state has approved medical and adult use cannabis, and they're primarily governed by state law. So they are comfortable participating and lending into the space because of that. But from there's probably south of 10 that are non-traditional bank financiers. And then again, 2 or 3 within a state that are providing this form of capital. And one of the things I always sort of look at is any type of the equity funds that are also out there. I was at a conference the other day, and I think that Chicago Atlantic, a publicly traded company, has said that they've put out $2 billion into the industry over the course of the life. So that's principal getting repaid and new investments. AFC Gamma, I think, had talked about 900 million, just south of $1 billion, that they've put out in the industry. So there is capital, but it's very concentrated amongst a grouping of non-traditional bank lenders. From what I understand, I think the largest bank company called Valley Bank out of New Jersey is a traditional bank, does more than just cannabis, but they also participate in it. So there's a handful of operators, and there's a difference between the mortgage REIT, Chicago Atlantic, AFC, Focus Growth, and your credit union. Those individuals understand and have been in the cannabis space for multiple years. You don't have to spend time educating them on the industry and or the market that you're most likely participating in, because they have already extended credit to operators in those states. If you're working within a newer company, newer state, if somebody was working in Georgia, for instance, and was trying to get a loan from a local Georgia bank, which is just medical, you're going to have to do a lot more educating for them. And what we're seeing now with these, there's definitely a disparity occurring between the rates and availability of capital. The larger non-traditional banks, they have a lot of dry powder. They have the ability to put money to work, but their rates are probably going to be anywhere between 12.5% to 17.5% once all fees, origination fees, monitoring fees, exit fees are put into place. Your credit unions and local banks are probably going to be 8.5 to 10.5. So there's a big spread between the two, but the local and regular banks are probably going to be capped at somewhere around 7.5 to $10 million, while the larger non-traditional banks can do 15, 20, 25, $30 million deals. So depending upon what form of how much capital you need will determine, who you need to go talk to.
Yeah, and I think where we've seen clients where they have been able to get, I'll say, a credit union or a local bank within a state, the requirements are still very, very hefty. 50% loan to value, personal guarantee or personal guarantees, and have even required pledging of certificate of deposits to secure that. So again, when we've seen it on a very limited basis, there's a lot of hurdles to get through.
Yeah,
I don't know if that's what you've seen, Tripp.
Yeah, the money, the non-traditional bank financings, right? They're not FDIC insured or NCUA insured. They're not taking demand deposits from your cultivation or retail. Your local banks and credit unions are definitely going to ask that if they are extending credit to you, that you change over all your demand deposits and payments through them. That is 95% of the time that I have seen. Personal guarantees, depending upon how large the organization is. If you're a single state operator with just a single dispensary or 2 or 3 dispensaries, they're going to ask for that. They're also going to ask for like equity pledges, right? So they're going to ask that you pledge the equity within those licenses to the lender. And they do that for a specific reason, right? If the company comes into financial difficulty, they have to, in essence, foreclose on the loan and take it over. And by doing that, then they need to be able to have the equity pledge that allows them to do it. But again, that's last resort. It is definitely not in a playbook. And if anybody who's on this call is back in the finance world, back in the late 1990s and early 2000s, there was a lot of loan to own. They are not in a position, nor do they want to loan money to you for you to default. That's not their game plan. They've set up and raised money from investors specifically to act as a bank and as a mortgage REIT that allows them to clip coupons, which is your interest rate, and then return that to their shareholders.
Mm-hmm. Yeah, a couple things that come to just wanted to mention is you talked about the interest rate and the fees associated with it, but again, what we've seen, and there's not a lot of equity movement, I'd say in the last 3 years, 4 years for sure, that the equity, they're looking for 35 to 50% return on the investment. So that's why a lot of our clients will look for the financing component, is because of the cost of the equity. But what Tripp, what tips to prepare and streamline the financing process? What are the key things that you would say to individuals or companies, organizations that have determined, you know what, we do need additional funding to build out the dispensary, to build out the cultivation, to expand. So what are the key steps that you would recommend that people or organizations do to streamline that process of obtaining the financing?
Yeah, the first, and I'm not going to necessarily say it's the easiest, but definitely the first is that you need to have your financials together. That is going to be the simplest request from them. Show me if you're operating and you have an operating history. Show me that you know how to keep financial records, balance sheet, income statement, statement of cash flows, and that you understand what is in each of those categories. Serving as a CFO for going through this process, they will. It always surprises me what they focus on. And it's usually focusing on something that's an outlier that deviates from the norm of the history of the company. And you have to be able to be ready to explain that. If you own property, if you own the cultivation facility, if you own the real estate under the dispensary, one of the requests, and I wouldn't recommend doing it until you get into farther negotiations with the bank, but one of the things that they're going to request is they're going to have you have an appraisal. Now, you have to understand, an appraisal is going to take anywhere from 30 to 45 days. The bank is going to dictate which appraisers they will allow you to use, even though you pay for it as the borrower. And then you also have to have a detailed enough financial model that allows the bank to understand what you are expecting over the time horizon for which you want to borrow money. So if you're going to borrow it for 3 years, you need to have a financial model that represents it for 3 years and layers in the debt that you're going to be borrowing, or 5 years. And it has to be detailed enough that they can basically pressure test your assumptions. What is your price per gram or price per pound? What's your cost per gram or cost per pound? And that you have justifications for it, right? I mean, they're in the business of lending money, but they're not in the business of making bad loans. And so having their financials, having an understanding of the real estate value, because there isn't a lot of players right now that are doing cash flow lending, which is taking a look at your free cash flow and giving you a multiple of that and allowing you to draw that down. What they're mostly looking at is, okay, Cory, you've got a dispensary and you bought it for $3 million and you own that real estate outright, but you want to get another dispensary. And so you are saying, look, I will pledge my dispensary and my real estate, and they'll give you 65, 70% sometimes loan to value if it's operating. That allows you to go buy a second dispensary. So they're going to go through all of the assets and liabilities that you have and being prepared and organized. Data rooms are great. The more organized the company is in making the initial request, the more comfortable the bank gets with lending the money. If they make a request from you and it takes you 2.5 weeks to respond to them, they sort of sit and say, wait a second, you're not organized enough, and I'm about to lend you $5 million. So, being responsive and being organized, I think, are key to increasing the likelihood of getting through the loan committee and getting it funded.
Yeah, you just you're making me think of, in regards of some of our clients when they've gone through financing, compliance comes into play as well. Are you meeting the state compliance requirements? What's your standard operating procedures? How do you make sure that you're being following them? And I know that quite a few banks, they'll do they have a rule that's called know your customer. So they will come out on a quarterly basis and make sure they understand that you're operating and being compliant. So there's the financial side, there's the legal documents, that you've got your organizational documents or bylaws, board minutes, things of that nature, as well as then your compliance component of it.
Yeah, one of the recommendations you touched on, one of the recommendations I make for my clients is that you have engaged a corporate attorney, somebody who can help you at the point in time of receiving a term sheet. Because the term sheet, while it's anywhere from 3 to 5 pages, is the guiding document for what the loan agreement is going to look like. So you want to make sure that you have everything covered in the term sheet that you want to show up in the loan agreement. If you're not comfortable with a 3 times coverage ratio, then make sure that the term sheet doesn't say 3 times coverage ratio. Or if you want to have a limited personal guarantee, make sure that that's in the term sheet, and don't try to fight that fight at the point of going to definitive documents, meaning definitive documents, the actual documents that are going to govern the loan. Because then the bank is going to turn back and say, but you agreed to the terms in my term sheet. Why are you now asking for this change? So even though it costs money up front, making sure that you have good legal representation from a firm that knows cannabis and knows how to do debt deals is important. I've seen, unfortunately, a number of companies that have not used that. And when we have a conversation, they're like, yeah, we missed this part, and so it's costing us a lot more money. And the banks are, they're trying to get as much money out of you as possible. But having good legal representation, good accounting, and also making sure that, specifically you talk with anybody from a tax perspective. Given cannabis and its unique tax structure, if you are not having somebody who's reviewing how certain aspects of the loan document will be treated for tax purposes, and or if you need to be compliant with quarterly tax payments, both state and federal, those things can trip you up, and you can end up in a technical default, meaning that you still are making your interest and principal payments, but you have breached one of the covenants in the financial document, and now all of a sudden the bank of the lender can impose default interest, which is usually 500 basis points above what you're currently paying. So if you're at 16.5% and you have a technical default, you're going to end up at 21.5%, which is just even more of a step on the throats of any operator.
Yeah, that's detrimental, but yeah, it's very important to, like you had mentioned at the very beginning regarding the term sheet, just fully understand. Maybe you could talk a little bit about the coverage ratio, 3 to 1. I guess I haven't seen that, but that would make me gulp.
Yeah, no, I mean, it's all going to depend on, the financial covenants are going to depend on where you are in your life cycle of the business. And, they will have they'll have a financial covenant, that your principal payments and interest payments need to be X times, your EBITDA needs to be X times your principal and interest payments. A lot of times I see companies also, which is to me a little bit unique in the cannabis space. My prior experience was in investment banking for about 17 years, is they'll put a minimum cash requirement on the company. And that is usually a function of somewhere of 3 to 5 months worth of interest that they want to make sure that you maintain and don't spend. So while they might loan you $5 million, they're going to tell you that you need to, at all reporting periods, maintain at least $1 million of cash in the bank. And or they do a interest reserve against it. So, all of these different covenants can chip away at the amount of free cash that you have to be able to use to expand your business. And that's why it's important to be able to dissect, analyze, and review the term sheets so that you know what you're walking into.
Yeah, and then what you make me think about, Tripp, is I know we have some of our clients that on the funding on their debt coverage ratio computation that they negotiated on the front end, that there's certain items can be added back, like startup cost, because those could make you in default if you don't have them built into when you're determining what is our debt to equity cash flow ratio. So maybe you could talk about that a little bit, just
Yeah.
making sure, and this is where the professionals really come in to help you make sure that you're getting everything considered up front before you get into an agreement.
Yeah, startup costs, one of the things that I push back on and spend a lot of time discussing, right? As you hit on it, Cory, is that say you're going to do a dispensary, and you know that the dispensary day one isn't going to be generating the free cash flow that it should be generating 6 months from now. So that dispensary opening is going to be a drain against your EBITDA, free cash flow, whatever the metric is that they're going to be using. So you need to make sure that you have an agreement with the borrower that says, either I can exclude this for 3 or 4 months, or I can add back these itemized costs for the ratio. And so it's imperative to understand, and I try to get this often very early in the negotiations, is because they're going to send you a set of parameters for how these are all tested. Can you please send me your calculation of what you're looking for so that we can move through the business aspects first? Because if I can't get through the business aspects of a loan, then I have no reason to incur legal costs from the lawyers negotiating it. So if you can ask for those specific details so that when you build your financial model, you put in those requirements to make sure that you internally believe that you're going to be able to pass all of those on a monthly or quarterly basis, for which they're going to ask you to report. And it, again, 90% of the term sheet deals with the business aspect of the loan. 90% of the time spent on the deal docs is the legal side. So that's why it's important to get those out of the way.
Yeah, and then I don't know if you call it risk testing or the term, but and especially we see this where there are new clients in a state. The price per gram is phenomenal. In fact, I'm thinking of like Massachusetts. I mean, compared to 2020, the sale price per gram, it's down 70% today compared to 2020. So, especially if you're going into a new market, the revenue per gram probably is going to be strong, but as time goes on, competition opens up, supply starts catching up with demand. Hopefully supply doesn't exceed demand, that you really have that the sale price per gram kind of figured out.
Yeah, I along the Massachusetts, I was down at the Benzinga, New Jersey conference last week. Then they were discussing on one of the panel conversations was that, the New Jersey market, adult use AU market, has gotten over $1 billion. It's been in play for about 3 years or so. But when it first started, and I'm going to make up these numbers, but it's to represent what was actually happening. There was like 25 adult use dispensaries. And let's just say that it was a make math easy, a $500 million market for those 25 dispensaries. So they had pretty strong revenue at that point in time. Now we sit at a market where it's $1 billion. Great, the market is doubled. But the number of dispensaries in New Jersey are now 250. So that's grown by 10x. So even though the market has doubled, the participants in the market who are eating at that pie have grown by 10x. So even if you were doing $2 million a month in a dispensary, that's now trickled down to doing on average $500,000. And if you don't show that type of understanding of where the market goes, the banks will do it for you. They will tell you that your assumptions, that the hockey stick in the cannabis space exists for a 3-year time frame under adult use, and then it starts to come down. And I think that where you see the greatest pressure in that change in adult use is in the cultivation side. The dispensaries will maintain a roughly 40% or so gross profit margin percentage. So if they were doing $1 million a month, they have $400,000 to come to gross profit. But if they're doing now $500,000 a month, they end up with $200,000 of gross profit dollars. And that's all you have to cover your expenses with. Great, my margin has stayed at 40% because you have that ability to sort of keystone what you're getting from the wholesaler, plus an average of 10 to 12% discount between what promotions you're running and other loyalty programs. But if all of a sudden you've gone from $400,000 to $200,000 in gross profit dollars, you've got to make sure that your expenses are lining up, and you're not carrying overly burdensome, payroll, rent. Those are your two biggest costs usually on a dispensary side. And that's where companies find themselves getting in trouble. And what ends up happening? Then the dispensary defers payments to the cultivators. The cultivators are now sitting with accounts receivables that are 35, 60, 90 days out. And the retailer is trying to get as much cash in. But once you've started to extend your payables too long, then the wholesaler won't sell to you. Then you end up with lack of diversification of products on your shelves, sales go down more. So it starts to become the self-fulfilling, prophecy that just winds itself all the way down.
Yeah, and unfortunately, what this all ties back to is repayment of debt. Just making sure that you have a good understanding deploying this capital. This is the market share that I'm going to be able to generate from it. This is the gross profit and so forth. So when you're making this investment, you're looking out over the next 3 years, 5 years, because that's how long it's going to take to repay that debt. So that's again where we are seeing the struggle is not the initial 2 or 3 years of the financing component when in a state where adults been new, but it's in the latter part that it becomes challenging. One other thing I did want to mention is I know that quite a few of our clients, that they can meet the parameters. We do what's called 471 little c for them, and it's really income tax based financial reporting, which under that position, you're deducting more of I'll say, usually your non-traditional cost of goods sold. But again, when we've worked with clients and financing, we're able to present and then also articulate here are the expenses. This is why it's falling as a part of cost of goods sold. Versus down below, the tax reason behind that, the disclosures that are made on the tax return. And again, most of the time, the bank is as long as you are able to articulate and provide support for taking that position, they seem to get pretty comfortable with that as well.
Yeah, I mean, as long the banks are again, the banks want to put money to work in and let's not, underestimate what these banks and non-traditional lenders are doing, right? They're lending into an industry that's still federally illegal. We haven't gotten rescheduling. We haven't gotten the Safe Bank or Safer Banking Act. We haven't gotten any changes in, decades, it feels like, for the way in which the cannabis industry is treated. But as long as it's done under, acceptable accounting rules, and the bank is willing to listen and will also be educated as to why are you taking this position, and then they'll go do their own research and come back and say, yes, you know what, Cory is right. You can take this position. We understand it. But also do what other things, to make sure that we don't miss. We've talked sort of a lot about EBITDA and interest, but banks are also going to make sure that you're paying your taxes. And making sure that you work with somebody from Cory or my years as the CFO, understanding what is deductible, what isn't deductible under 280E, and modeling that effectively. And I just give a simple guideline that if your effective tax rate is somewhere between 65 and 75%, then you're doing a good job of modeling it correct. And given every state is a little bit different, some states don't apply 280E. They allow you to take the full regular deductions, but federally speaking, make sure that your tax line in your financial models are hitting somewhere between 60 to 75%, and that cash is coming out of the system so that you understand what is really going to be happening to your company down the road.
Yeah. Well, I see that we're butting up to the end of our time. Tripp, I do appreciate you joining and talking about the financing in the cannabis industry. It's so unique, and as you kind of we've gone through multiple evolutions of either raising capital or financing in this space, and I think it'll continue to evolve and change as we move forward. And I would just like to say it to any of our listeners, if you're interested in finding out more about trying to do financing in the industry, I would highly recommend reaching out to Tripp, and just has a lot of experience dealing with a variety of banking institutions out there and all in the industry. And like Tripp's been in it since 2014, just like us, and dog years, it's a lot of dog years.
Yeah,
out
and
there.
I think Cory, you and I have started working together in sort of the 2015 or so time frame. So, I've known you now for almost a decade. So I appreciate that. And, it's great to have smart minds like yours and all that your group does, really assisting the cannabis industry in navigating what are definitely not just financial covenant times, but tax work, audit work, financial review. Those are all things that the bank could ask for or a lender could ask for. And working with you over the years, you guys do a great job.
Oh, thanks a lot, Tripp. Have a good rest of the week, and everyone, thank you for joining.